Great to have you with us on this Friday. Malcolm, let me ask you about guidance and the big names that are going to report next week. Some of them are names that have announced layoffs in just the past couple of days. Do you think that's going to color the kind of corporate guidance we're going to get on these earnings calls?
Not so much, Carl. I think Greg was making an interesting point that a lot of the companies that we hear about these big layoffs from were already huge to begin with because they were hoarding so much talent. So if you think about a name like a Microsoft, an Amazon, an Alphabet, Google even, these companies still have significantly more employees on the books than they did prior to COVID, before they did all the hiring, after they go through these massive rounds of layoffs. So I'm not as concerned about the numbers strictly from a headcount perspective. Obviously, it matters that people are going to lose their jobs based on these announcements, but I'm not as concerned from a headcount perspective about hearing more of that through the earnings. I am concerned, though, when I hear about a name like a Wells Fargo, maybe a Rocket, somebody like that in the mortgage space that's getting rid of entire units because they see significant headwinds coming in their space. So in the tech world, layoffs kind of come and they go. They still tend to have a ton of talent inside of those firms. But specifically, like looking at the entire economy, the real estate space, mortgage specifically, is where I'm a lot more concerned when I see massive layoffs.
Julie, I was thinking maybe one of us at this panel would be a rip-roaring bull. I don't think I can count on you for that either.
Yeah, I think right now we're continuing to see the market being driven by three things, really: earnings, which we're talking about and seeing that slow down, inflation, which is softening, and the Federal Reserve, which has made it clear that taming inflation is still their number one priority. So right now, I think the key to this market is earnings, and we continue to expect to see a slowdown in earnings for the current fourth quarter reporting season. And for 2023, we're expecting an earnings recession, and that's really because what we saw last year, that the Fed hiked interest rates by 425 basis points, and we don't believe that the earnings are reflecting that right now, and that the Fed's aggressive actions over the past year, and think that investors really need to embrace for some earnings pain ahead. And so, we really don't see any sustainable stock market rally ahead. The risk reward, I think, for U.S. stocks in the near term is not as appealing to us. And so our mid-year target for the S&P 500 is 3,700. So really just below the current levels that we're at right now.
Right. Let me ask you about international guys, because we've had some recession calls in Europe pulled over at Goldman. Morgan Stanley says China growth is underappreciated. They're buying equities over bonds in Europe and got the best start to the stock 600 since data began. Right. How can all that exist if we're so weak here in the States?
So you have a number of unique catalysts that are happening there, right? Obviously, China opening up again is one of the biggest. And so China being the end market for a lot of those markets that people are investing in, China being the number one consumer of energy, supporting the stocks, really separating from the commodities to some degree over the last couple of months. And so there are unique elements in Europe and in Asia that will enable those markets to, coming off of bottoms that were typically lower than we've experienced here, that would allow those equities to run a little bit farther, a little bit faster. Obviously, we have our own unique political situations here.
Not to say they don't have interesting political dynamics.
Of course. But, that might directly implicate the markets because they're so unusual, more so than is happening in some of those foreign markets. But there is opportunities, particularly when you identify the sectors that are poised to benefit from some of the current structural circumstances.
And some of those are?
Energy. We just named one. If China's going to open back up, right, then with supply continuing to be constrained and with demand coming back, energy is one that continue to show legs, I think. At the end of the day, like I said, the stock prices in the companies have separated a little bit from the commodities. They continue to run even as the commodity prices have come in. But if we're going to get elevated commodity prices again, if we need to see Europe refill its gas reserves, if we need to refill our own strategic petroleum reserves, right, while China's coming back online, then you're setting up for a structural situation that favors energy stocks with that high free cash flow generation.
Yeah.